right. Well, I'm really excited to actually be here now. And thank you so much to the AV team for sorting out the little issue we had. So we may know how to build blockchain.
She's great, actually. You should meet her.
But we can't figure out AV system. But we got it working. So today I'm going to talk about cross-chain liquidity and the future of financial computation. Obviously, we're all here because we love L1s. We're super excited about what's happening in the AVAX ecosystem. And so I just want to add a little bit of context as to why what we're building is so important and why I'm personally so excited about all of the L1 computation that's becoming available across all of these new blockchains and bridges that are being built. So with that, if I could ask the team to go to the next slide. Disclosure, this is not financial advice. My legal team has asked me to share this, but nothing I will share with you is financial advice. Next slide, please. So, liquidity. So I always like to start by talking about high-level concepts and level setting on what these things mean. So liquidity, I always like to use a meme from Wall Street. Next slide. So if anyone's seen the movie Wall Street, you might recognize this. Next slide, please. Could you go to the next slide, please? So Wall Street, great movie, main character, Gordon Gekko. There's a great quote in the movie where Gordon Gekko is on his beautiful 80s brick phone and he says, I'm not talking about driving a fucking BMW. I'm talking about 50 million, 100 million liquid. So what does liquid mean? What does liquidity mean? It's actually one of the most misunderstood concepts in crypto, I think. So I want to talk about it today. Next slide, please. Next slide, please. Do you want me to do a hand motion? Maybe I'm going to do a hand motion just so we make it a little easier. So why does liquidity matter? What is it? Liquidity really is at its core the ability to buy or sell an asset at a price that is equal to the price you got it at. So basically liquidity is a trade-off between price and speed to buy or sell. The way an order book gets constructed, how many people here have ever looked at an order book or visualized an order book? It's a pretty nerdy thing to do, but it's helpful to understand in order to understand why liquidity matters. So an order book is what I've tried to illustrate here with this really simple graphic. Basically, a bunch of people put in buy orders and a bunch of people put in sell orders. They'll put them in at different prices and there'll be different quantities. So what I'm showing on the vertical axis is the range of prices, and what I'm showing on the horizontal axis is the number of orders at those prices. And so what tends to happen is there's a specific range within which those orders clear, where buyers and sellers match, at their size matches, their price matches. That's where clearing happens, and that's called the tightness of the market. So liquid assets typically are very tight markets. It means that the buy-sell spread is fairly narrow, and there's a ton of volume concentrated in a very tight range. Liquid assets can be sold rapidly with minimal loss of value anytime within market hours. Now, the great thing about crypto markets is they operate 24/7, so market hours are all the time. Although in crypto markets, it is important to note liquidity does actually vary based on market hours on different venues. It used to be that during Asia trading hours, there was much more liquidity, typically in tether trade pairs, and during US and Europe trading hours, there was much more liquidity in US dollar or USDC trade pairs. So it's interesting to note that liquidity is not consistent, even though crypto markets are open 24/7, which is something just to keep in mind. Now, in traditional markets, there's a specific group of people who provide this liquidity. They're called market makers. You've heard of market makers probably in the context of an AMM or an automated market maker, and we'll get back to that. But liquidity is really important. It leads to tighter bid-ask spreads, lower liquidity. Assets that are less liquid tend to have wider spreads, not as much volume, and a much broader clearing range. So that's how an order book works at a high level, and liquidity matters because you want people, especially in a cross-chain world, to be able to move into and out of sizable positions fairly quickly without any loss of value. Next slide, please. So traditional markets are NGMI. They are just not going to make it. So the way traditionally you would trade on a market is you would have a number of different brokers, and these brokers enable you to do a variety of different things. You discover prices, right? You can see in the order book the bid-ask spread. You enable execution. So I put in my bid. I see where the offer is when the bid and the offer match. It clears and the trade executes, right? The trade gets made. Then there's a whole process of margining and clearing, which is, using the securities or the assets you have to obtain more leverage, the process of providing settlement instructions from one counterparty to another. Then there's a whole settlement and reconciliation process, which actually takes a couple of days. The issue is that each one of these brokers, each one of these markets is effectively a separate database. And the existing trade life cycle basically requires these financial intermediaries to copy and paste data between their proprietary databases, which is hugely problematic. So what is crypto doing that's different, and why the heck does it matter? Let's talk about that. Next slide, please. So what is cryptocurrency? I have probably slightly different articulation of what I think cryptocurrency is than most people. So let's talk about it. Next slide, please. Cryptocurrency is basically turning computation into money. That's what Bitcoin does. We started, as humans with these shiny rocks, right? We had physical objects that denoted value. The great thing about a physical object, if I have a shiny rock and I give one of you a shiny rock, that shiny rock, there's still only one that exists, and you can verify that you own it because I have physically given it to you and it's now in your physical possession. Now, when we took these shiny rocks and we turned them into pieces of data, which is effectively what modern banking is, it started to get a little bit more difficult. If I have a piece of information and I copy that piece of information and give it to you, there are now two pieces of information. So you have to be able to verify that I deleted that piece of information so that there's only one. This is effectively what banks do today. They spend trillions of dollars a year sending these little pieces of information around and making sure that someone didn't fuck up in copying or deleting data from one database to another. That's oversimplifying it, but that's effectively what we're doing. It's pretty inefficient. And then along came Bitcoin. Bitcoin's not a shiny rock. It's not a database. It's not a bank. Bitcoin is effectively saying, hey, we can use computation to solve this problem of trust when we're moving digital value around, when we're moving pieces of information around, and we can do it with computation. Next slide, please. What's really cool is that Bitcoin actually puts a price on financial computation. So historically, it's very difficult for you to price how much a transaction at a bank costs you. You could try to arrive at some sort of like loose number based on how many transactions the bank processes, its profitability, cost basis for engaging in that activity. But the Bitcoin network prices financial computation in real time. Bitcoin is the world's most secure independent financial network to date, and the demand for Blockspace is a function of the demand for secure financial transactions on the Bitcoin network, which is super cool. Then Ethereum came along and extended that concept further by introducing financial computation in the form of smart contracts. So there's a key difference here. Transactions, hugely valuable. Computation in the form of smart contracts, also hugely valuable. And now there are all of these new and emerging L1 protocols like Avalanche that are introducing really different models for how we can price financial computation by offering different security guarantees or opting for certain measures of centralization, which, by the way, centralization is totally fine if that's a trade-off we want to make for efficiency in other areas. So I'm not a decentralization maximalist. Let's go to the next slide, please. Okay, so here's what's really cool is Blockspace, right? Financial computation is in and of itself a scarce asset. If we look at Bitcoin fees, right, which are effectively pricing secure financial transactions, the demand for these is cyclical, it varies over time. Now, interestingly, the demand for Ethereum block space has been more persistent and has grown over time. That's sort of an indicator, I think, that financial computation and more sort of composable smart contracts are actually incredibly valuable and are more widely utilized. Financial transactions also incredibly valuable, but as we see with Bitcoin, we're not seeing a lot of demand for Bitcoin block space today. Let's move to the next slide. And we see this reflected in pricing, right? If we look at Bitcoin transaction fees over time, they've risen and sort of stayed where they are. On Ethereum, it's much more variable. Typically, gas fees tend to spike when there is a lot of demand for computation on the Ethereum network. And it's been really cool to see over the last few months how that's been ameliorated by people moving to other chains or to layer twos to start to offset some of the demand for Blockspace and Ethereum. Next slide. So what's really cool is with the advent of cross-chain bridges, with the advent of more L1s, and with the advent of more financial computation on new blockchains, what we're seeing is that financial computation itself is becoming a fungible asset. So what do I mean by that? For commodity to be tradable, you need to be able to move it around to where it's needed in a cost-effective manner, right? If I can't get, my oil to the end market where it's needed, it's really not very useful to me. The challenge is historically, if we wanted to do financial compute on another chain, it was really expensive. The effort and time that would be required to rebuild a specific application on a new chain would have likely defeated any short-term or medium cost savings from doing that, right? If I had an Ethereum-based application and I wanted to build it on another chain, there weren't any, real EVM compatible chains that I could utilize that had an adequate amount of financial compute available for me to do that and make it worth it. But now that we can actually move this financial compute from one chain to another, as well as the actual functions themselves, this opens up a whole new sort of design space where we can make financial computation itself fungible. And if that sounds crazy, we're going to talk more about it. And I promise, well, I can't promise. Hopefully, when I'm done, it will make sense. It might not, and then that will be my fault. But with dozens of L1s and L2s, there are now so many faster, cheaper alternatives to Ethereum that support the same types of financial compute. And again, that's not a criticism of Ethereum. It's not a criticism of Bitcoin. It's just the fact that there are now way more choices when you want to engage in secure financial transactions or secure financial computation. And again, choice is one of those values that in the crypto space is hugely important. People should be able to make choices on what they want based on what parameters are important to them. If we move to the next slide. So we see this, right? Here's an example. A few months ago, I tried to send $1, I tried to swap, $1 of USDC on SushiSwap, and swapping $1 was going to cost me $57.85. That's crazy. I think that's wild. I have this vision that in the future, all financial compute, all capital markets, all financial sort of activity will happen on public blockchain networks, but this isn't it. This is really not suitable for the average user who's transacting $5, $10, $100. If you're transacting tens of thousands or millions of dollars at a time, this fee is probably acceptable to you, right? But for people who want to engage in sort of everyday activities, for people who aren't crypto rich, this is really expensive. So how do we fix this problem? Next slide, please. Well, the real question is, can we make liquidity and cross-chain liquidity in particular fungible as well? My thesis, yes. What we've seen so far in the market, I think also yes. Next slide, please. All right, so the objectives we have here is when we increase throughput, we want to increase speed, and we want to lower cost. So to optimize for scalability, we need to have inherent trade-offs in regards to decentralization and security. And again, as long as we're being transparent about those trade-offs, I think those are perfectly fine trade-offs to make. You don't need like fully decentralized, fully, permissionless networks to buy coffee necessarily, right? There are some instances in which having some degree of trust can be useful because it makes things more efficient. There are other instances in which we really value those things. And I think we have to be more nuanced about where those values matter and where perhaps they don't matter as much. Next slide. So the first example of cross-chain liquidity that I want to talk about, that probably isn't the first example that comes to mind for you, is putting dollars on chain. And this started happening as early as 2013 with the advent of Tether. So this was really, to me, the first example of taking an asset that we needed in the crypto ecosystem, a place where we needed liquidity. We didn't have any dollar liquidity. We had no ability to borrow dollars. There was zero liquidity here. So we put dollars on the blockchain. We digitized dollars. We did this in the absence of prime brokers, banks, and other traditional credit providers in order to make the dollar-denominated financial system and the crypto financial system compatible. And today, over 10% of the crypto market cap is stablecoins, and that number is growing. The top 3 stablecoins are the highest by market cap. That's Tether, USDC, and BUSD, but they're all pretty centralized. Therefore, they're exposed to banking risk and regulatory risk. But again, they fulfill a really important function. They provide liquidity to the market, which is really important. While the sheer volume of stablecoins in circulation is really impressive, it's crazy that 85% of daily trade volume still comes from only Tether. And most stablecoins actually end up having really low velocity because they're used passively. So let me explain what that means. In the chart on the left, what I'm showing in the purple bars is the market cap of each of the top 10 stablecoins. And the white dots and the white line are showing the velocity on a scale of 0 to roughly 1. Velocity is the number of times that a dollar is turned over, and it's sort of a measure of the utility of a dollar in a particular system. So an interesting thing you'll notice is the utility of a tether, the turnover tether, is very high. On average, a tether is turned over about every 1.2 days. The velocity of USDC, by contrast, is very low. Why might that be? Well, a lot of USDC is used in yield farming. It's often a very popular a pair that's used in new farms that are launched. So we see much less velocity on the USDC side. And then there are a number of other stable coins. There's sort of this long tail. Some of them are more decentralized. Some of them are still fairly centralized and require a bank to effectively take dollar deposits. And then have a custodian that sort of turns those dollar deposits into dollars on chain. But you can see all of them still have really low velocity. So one of the challenges for the stablecoin space is, how do we improve decentralization, and how do we increase velocity and actually make these things useful outside of just passive yield farming opportunities? Next slide, please. The next step, right? So once we put dollars on chain and made the dollar ecosystem compatible with Bitcoin, Ethereum came out, financial computation through smart contracts became a huge theme, but we had another issue. All of the wealth was in Bitcoin. So what did we start to do? We started to move Bitcoin across chain, right? This is another example of taking an asset that historically wasn't, where liquidity wasn't fungible, and making that liquidity fungible by representing Bitcoin on Ethereum. So if we look today, over 2% of the Bitcoin supply is actually wrapped and put onto Ethereum. That's pretty crazy. We're looking at around $18 billion today, or around 300,000 Bitcoins that have been wrapped and moved over to Ethereum. If we look at the implementations of this, though, you can see WBTC, or wrapped Bitcoin, makes up the bulk of that. HBTC, RenBTC, IBTC make up a big chunk, and then there's kind of a long tail. But the majority of these, again, are custodial, right? And again, not a criticism. Centralization is not a bad thing, just something to be cognizant of, because it creates a risk vector that we just need to be aware of. So dollars on chain, Bitcoin now on Ethereum, right, to become compatible with financial computation and to make Bitcoin liquidity more useful, more accessible in DeFi. So what comes next? Next slide, please. Well, the next thing we did is we needed to make financial computation on Ethereum itself fungible, right? So we started to see in 2018, 2019 is gas fees started spiking. Network demand for Ethereum Blockspace was exceeding network capacity. And so we needed other smart contract solutions, other platforms that would enable financial computation on chain. So we saw the advent of layer 2s. There's currently about $6 billion of Ethereum-based layer 2 total value locked, and that's dominated today by Arbitrum, which makes up over half of that volume. And then, surprisingly, DYDX, the perpetual swap trading protocol, makes up almost another 20%. So the majority of the layer 2 volume today is driven by one specific implementation, and then one very specific application, which is oriented around trading, right? Financial transactions. What's really interesting is L2 solutions still have some inherent limitations because they fully or partially derive their security from the layer 1, right? So users don't have to rely on the honesty of L2 validators for the security of their funds, but there's still some limitations based on the underlying consensus model and underlying security model of Ethereum. And we're starting to see a wide mix of platforms and applications are actually pushing their activity, are pushing financial computation onto L2 to bring costs down, right? There are also use cases, for example, POAPs, right? Who here has minted a POAP? I certainly have. When you mint a POAP, it's done not on Ethereum, but it's done on Polygon, which has much lower fees. And in fact, minting is free, which is a great thing to have. Next slide, please. So we started with putting dollars on chain, then we put Bitcoin on Ethereum and enabled it to become compatible with financial computation, i.e. DeFi and yield farming. And then Ethereum became too expensive because there's too much demand for financial compute on top of Ethereum. So we created these layer 2s. What we saw next, last summer, we saw the advent of Crosschain. And the world of cross-chain interoperability has become really interesting. There's 24 billion of TVL that's currently bridged away from Ethereum, and 20 billion of that bridging volume actually took place in October of last year. So there's kind of this really crazy moment, and we'll talk about what that moment was because it's really interesting. And this activity is not just concentrated in the hands of a few whales or trading firms. There are over 60,000 unique addresses that have deposited on bridges in the last 30 days. So this isn't a phenomenon that's limited to a small set of power users, but it's been pretty widely utilized across the DeFi landscape by users of all types. What's crazy is what led to this huge spike of cross-chain bridging was actually the launch of the Ronin Bridge. Does anyone know what the Ronin Bridge is? Quick question. Okay, some people. The Ronin Bridge is part of the, go back, please. Go backwards, other direction, backwards. Okay, I'm gonna keep talking. If you guys could go back 2 slides, that would be amazing. If not, we will get there, but please go back 2 slides to slide number 19. So when the Ronin Bridge launched, it was for Axie Infinity. So Axie Infinity used to be built on top of Ethereum, very expensive. So they built their own blockchain, and then they had this bridge where you could migrate your assets and migrate your financial compute over to this other chain. So what's been really exciting to see is users are getting more and more excited, and they're getting more open to the idea that they may need to move their assets cross-chain in order to lower the cost of financial compute. And there's also a really cool design space that's opening up now where you no longer need to yield farm or do things with tens of millions of dollars or tens of thousands of dollars, where you can actually afford to do things with $100 or $200, which I think is super exciting because it allows us to onboard more people into the world of DeFi, Web3, NFTs, makes it more accessible, but also brings in new users who are going to experiment, who are going to try these things out, allows us to build new use cases, find new opportunities to actually use this underlying tech, which is pretty cool. So my view is that in the future, all assets, all liquidity is going to become fungible. Today, about 10% of the market is already stable coins. So that's one type of interoperability play. 1% of the market cap is wrapped assets. About 2% of the market cap is L2s and bridges. And we haven't even talked about liquid staking derivatives. So if we look at the overall crypto market, around 15% of that market today is actually already focused on bringing about new efficiencies in financial computation, financial transactions through bridging or through cross-chain interoperability. And as this asset class grows, I think we're going to see more migration across various protocols for users and devs alike as we find new ways to leverage cheaper, faster financial computation. Next slide. So what does this mean? What this basically means is historically, the only market makers were financial firms. You've probably heard of the name Citadel, but you probably have not heard of KCG, Flow Traders, or Virtu. These are some of the largest market makers in the world, and becoming a market maker requires a lot of money, as well as risk capital, specific regulatory status, and market structure varies by the asset type. So each firm tends to specialize in specific markets, whether that's commodities, FX, Forex or currency trading, equities, etc. And firms gain edge through flow, their technology and infrastructure, and their relationships. Now, in this new world we're building, anyone can be a market maker, which is super fucking exciting. anyone who holds crypto assets, anyone who has a risk appetite can become a market maker via liquidity pools and AMMs. Because all of these assets settle with finality to the network, liquidity is hyper fluid and it can migrate across chains to capture juicy yields. And we've seen a lot of that in the Avalanche ecosystem. Some of you degens in the audience, I'm sure, have bridged your assets from other chains over to AVAX to take advantage of some of the really crazy yields you've seen. And apes, right, which I'm calling us degens, apes here gain edge solely through market intelligence, their speed, and their risk tolerance. And sometimes scale or having a lot of capital can actually hinder your edge. So it's really exciting that we're moving into this new world where power is no longer with institutions. Financial opportunity is no longer limited to these big institutions, but anyone can participate. And hopefully, with more and more of this activity happening on newer L1s that still have very low cost of financial compute, it can become much cheaper and much more accessible to a much larger audience. Next slide, please. So crypto is just the beginning. Today, crypto is a teeny tiny market. Cryptocurrencies themselves are a $2 trillion market. Precious metals, literal shiny rocks, is a $12 trillion market. I think that we can do better than shiny rocks. So hopefully over the next few years, we can at least exceed the market cap of shiny rocks. But I think it gets much bigger than that. The M2 money supply is 40 trillion. Global equities markets are 106 trillion. Real estate is 300 trillion. And all of these things can be represented on chain, traded on chain, and become liquid, fungible, and hyperfluid, which is scary to some people, but super exciting to others. I'm on the super excited side, but maybe some of you might disagree. Next slide, and this is my last slide, I promise. So I'm really excited about this world. Sorry, could we go to the next slide, please? Next slide.
Yeah.
Okay. I'm really excited about this world. It's everything. And I want to comment on making computation. So if you're building anything in the question space, if you want to bring more liquidity to Avalanche, if you want to use Avalanche to bring more financial assets on other chains, out. I'm on Twitter at Meltem or at Feel free to reach out to me. I would love to. Oh, sorry, I can't be there. Thank you so much for having me today. Thank you that you are able to.
Thank you so much. Meltem.